Hello and welcome to this very special pre-budget show on the state of the economy. And joining us in the discussion to kind of decipher the state of the economy, we have three experts. We have with us Ashima Goyal, Professor IGIDR, Bombay, and also member of the PMEAC Council. We have Anantha Nageswaran, Dean of the IFMR Graduate School of Business, that is Kriya University, and Dilip Chenoy, Secretary General, FICCI. So let me start by asking all three of you, what is your assessment of the state of the economy? There is broad agreement that growth is slowing down. The last quarter saw growth dip to a 20-quarter low, but we ended the year at close to 7%, 6.8%. So how serious is the slowdown really? So on a scale of 1 to 10, where would you place the overall health of our economy? Let me start with you, Ashima.
I would place it at around 6.5. Because some people are saying that with the stable election outcomes, it should recover on its own. But I think we've been seeing a slowdown for the last 4 quarters. And what was really worrying to me personally in the last quarter was there were clear signs that private investment was slowing. Because for a very long time, this has been laggard, and I think end of 2017 it was looking up. And that is really required for the economy to grow in a sustained way. But I think what happened was that the slowdown in NBFC credit growth has hurt consumption durables and therefore from that investment demand. And there seems to be a general fear in the markets about credit risk. There is a reluctance to lend. So in the real estate sector also we are seeing a lot of stock of unsold houses, etc. So all this requires some policy help to get out of this. But I think at this stage it's not really that serious. It's more a kind of fear, and when there is fear in the private sector, then the government is the one party that can afford not to be fearful and can afford to do something. My banker friends are telling me that the only credit demand is from public sector firms, no private sector firms. So they are sustaining investment and demand at present.
So Anant, Ashima is worried, but despite that, she places the health of the economy at about 6.5, which is not bad going, at least by my standards. Remember our times, not like today's CBSE standards where even 99% seems to be par for the course. But even so, 6.5 is not too bad. But where would you place it, Anant? And are you worried, or how do you see the health of the economy?
Yeah, actually, when I first heard her begin speaking that she said she was worried, I was looking for a number below 5. But I also felt pleasantly surprised by her score of 6.5. I would place it at between 4 and 5. I think we have 5.8% year-on-year GDP growth, but it has been slowing, and monsoon in the first month has been significantly below par, etc. And then the NBFC cloud is still there. So I think there are lots of intractable knots here. I would even consider US-China rapprochement as a negative for Indian GDP growth at the margin. So there are many knots to be unshackled here or untangled here. So I think we need a collective micro and macro level actions from both the government and other players in the economy to slowly unravel this situation and bring the score to 8 and above out of 10.
Okay. So Dilip, both Ashima and Anant are worried. Anant much more than Ashima. So let me now turn to you, because both Anant and Ashima are economists and hence are likely to look at the state of the economy more through the prism of macroeconomic numbers like the GDP growth rate. However, as Secretary General FICCI, you are likely to have a very different yardstick. In fact, slowing car sales, two-wheeler sales, lower earnings and so on. So what is your assessment? Would you discount what the GDP numbers are telling us? Are things better or are they worse? What is your sense, Dilip, from where you are sitting?
So, thank you, Maithili. You know, it's very interesting. We actually had a meeting just last week where we had a lot of industry and economists around the table, and as in such discussions, the GDP numbers came in for discussion. And in fact, I found it quite interesting that 2 or 3 actually industrialists said that, you know, GDP numbers may actually be a beacon for something, but in our businesses we don't look at it. We are looking at, you know, how our businesses are growing, how is competition actually growing. And 3 things came out very, very clearly. And the first is, and it goes to Ashima's point about saying there's no demand for finances, for fundamentally that the private industry is unable to raise capital despite the consecutive rate cuts by RBI. The lower rates are not transmitting down to industry. And also, especially for the medium and small industry, they're having a huge challenge getting funds. So, the availability of capital for investment is actually very, very difficult. And if you look at the NBFC crisis, and if you look at which were the sectors that NBFC lending was actually driving, and you yourself mentioned automotive, automotive is negative. Tractor sales are also negative. If you look at the capital good orders, the capital good projection for this last month, which was May, even there it is amongst the lowest growth. But in some sectors now, if I take textiles, if I take some other segments, capacity utilization is actually exceeding 80%. So what that indicates is these sectors, if they will meet future demand, need to be investing now. And therefore, the next 2 to 3 months, you might see the sectors where capacity utilization is around 79, 80, 81, 82%. You will find investment actually happening there. So there are some sectors which are doing well. The mineral sector, other than the challenges with in some states with the mining bans and all of that, seem to be doing reasonably well. There are all the consumer durables sector which is actually having a challenge. The FMCG sector is facing a very unique challenge this time in terms of growth numbers. When GST kicked in, they reaped a huge benefit. So the growth rates were phenomenally high and the returns were high, and therefore compared to that, you might see growth low. So it's a mixed bag depending on which sector you are. But in the survey that FICCI just did, and we released it last week, there seems to be some kind of a guarded optimism about the future. And they're hoping that, with the elections over, right? With the elections over, the new budget coming in, it might lead to change.
Okay, so when Dilip first started off, I thought, my God, what a bleak way to start the debate, because both Ashima and Anant were a little downbeat. Fortunately, Dilip has ended on a slightly more positive note, that it is a mixed bag. There are some, rays of sunshine that we can see through the rather bleak picture. But if I were to take a more granular look at the other broad measures of economic health, then apart from GDP growth, maybe I would look at, internal health measures such as those reflected by the fiscal deficit, then external health reflected by current account deficit and inflation. And if we were to take these one by one, let me start, say, with fiscal deficit. Since that's the immediate event on the economic calendar, and the budget really is about the fiscal deficit, that is the most important number. The interim budget put it out at about 3.4%. How important is it to stick to this number, Ashima?
I think it is important to stick to it because, we are now guided by a long-term macroeconomic framework, and it leads to damaging of credibility if every time you are deviating from the path. And so I think this government, the last 5 years, the last government really committed itself to fiscal consolidation, and we'll be looking to see what happens with the first budget in this term. The signal that is given will be important, but I think that over the long term we need to maybe adjust this macroeconomic framework, the FRBM Act, to allow some counter-cyclical adjustment, because so many people are talking about the necessity of some stimulus, but our macroeconomic framework does not allow. But I think there are other ways of giving a stimulus, which is by preponing expenditure, firing quickly. I think the last government did this successfully. Earlier, expenditure always used to take place at the end of the year. They brought it forward. And then the kind of things you are spending on, so some reallocation of expenditure, cutting unproductive sort of subsidies, etc. And see, spending on housing is very positive for demand. Yeah.
Anand, Ashima spoke about the need for a counter-cyclical policy. So that brings me to my next question. What really is the sanctity of this 3% fiscal deficit that expert committees repeatedly seem to come back to? Given that deficits are not only inevitable, but almost desirable perhaps in developing countries, since no government will be able to meet all the demands for expenditure from revenue alone. Should we, as Ashima said, focus on the quality rather than the size of the fiscal deficit, Anand?
I mean, in principle, one cannot fault that statement that the quality of expenditure might matter on most occasions than the quantum of fiscal deficit. But obviously, we are looking at the union government's fiscal deficit, but the consolidated number should be around 6% between union and the state governments. And then we also have the public sector enterprises. So if you really look at the general government deficit, we are between 8 and 9% of GDP. And that isn't a small number, because the European Monetary Union's Maastricht criteria was about not just the so-called federal government deficit, but the general government deficit. On that basis, we are already quite high. And I think at the same time, yes, counter-cyclical policies are important. And I would agree with her that we can relax the number, provided we can credibly demonstrate that the relaxed fiscal deficit parameter is definitely earmarked for something productive and which will lead to enhancement of potential growth and also giving a short-term cyclical boost, then I think the market will be able to accept it. It's a matter of a credible policy making and communication as well if we end up relaxing the union government's budget deficit constraint.
Well, let me just interrupt you there for a moment, because now it's time for us to slip into a very short break. We'll come back and address the remaining two parameters of the state of the economy, but after the break. Welcome back. You're watching a very special pre-budget show on the state of the economy, and we're looking at the major parameters that measure the health of the economy. Now let me move to the third, which is the current account deficit. Ashima, we ended the year with a current account deficit marginally higher at about 2.1% of GDP in 18-19, up from 1.8% the previous year, on the back of widening of the trade deficit. Should we worry about this in the light of growing trade tensions? About just now we have, Trump waxes and wanes. Are trade tensions kind of dying down? Should we worry about the current account deficit, Ashima?
Yes, I think that is one of our big vulnerabilities as a nation, especially given our dependence on oil imports. We need to raise our exports. It's also important for creating employment. But I think given that dependence on oil imports, we can't afford to follow the cheap currency route. And in the current world scenario where there's this focus on currency and trade wars, we anyway would not be able to do it. So the way for us to address or reduce the current account deficit in the future is really to encourage productivity, this ease of doing business, but our currency must not be allowed to appreciate above 69. We've done some work here which suggests that 69 to 71 is a equilibrium real exchange rate. In nominal terms, gives an equilibrium real exchange rate for India currently. And the problem is that in the past few years, we had allowed too much appreciation that hurt a certain segment of exports, such as textiles. Maybe there are certain price sensitive components, but overall to increase productivity and ease of doing business, and maybe make regional arrangements, because with the US there are problems. And then of course save energy, reduce our dependence on oil imports, move to renewable power. All these are sort of long-term things the economy needs to do. But that said, I think a 1.5 to 2% current account deficit we will be able to finance. One encouraging sign in the very latest data is that invisibles exports have increased. So there is something positive happening there. Even though there was some sort of not as much FDI came in as expected, FPI came in, and invisible exports have also increased.
So Anand, what is your assessment on the external front in terms of current account deficit? Are we in safe waters, or should we worry about, and how much can we really run up our current account deficit to? What is the already safe level, Anand?
In general, of course, we always say the safe level of the current account deficit is a level that the overseas financial investors and the markets are willing to finance you. So there isn't a hard number which will be deemed safe. So given that overall concept in mind, on balance, in the current global context, I wouldn't worry about our current account deficit at 2.1%, even if it extends to 2.5%. Because if we were talking of enhanced fiscal slippage, it would result, everything else being equal, it would result in a higher current account deficit. But because the US is looking at cutting rates and there is a clamor for looser monetary policy in the developed world in general, on balance, I will be less concerned at the moment about current account deficit being one of our worries.
Okay, so Dilip, both Ashima and Anantha are not so worried about the current account deficit. But the fact is, ultimately, what matters is how is industry preparing itself to face a world of gathering trade tensions? Are there specific industries which need to be particularly more concerned about it? Or is industry as a whole relatively confident that we have a strong domestic market and so external demand does not really matter? Dilip, what is your sense?
No, I think this is something which needs to be addressed, and I think the Industry and Commerce Minister, Mr. Piyush Goyal, I mean, just few days after taking over, had this great combined meeting of the Board of Trade and the Trade Development Committee, and three things actually came out there. While there's a lot of focus on the ease of doing business, I think there's not enough focus on the cost of doing business. While we are looking at, and the two are not related, ease of doing business may actually improve, but the cost of doing business may actually go up. And a lot of people pointed to different specific small things that are adding to the cost of doing business. And unless we are not competitive, we can't actually export. And Ashima made this point that in sometime in the immediate past, we were faced with a different exchange rate that was not competitive to exporters, and I think we should not allow that to happen going forward. It's a very thin line that we have to actually tread. But most of them, those companies that are integrating into the value chain of global companies, seem to doing well. And what the data is suggesting is that the import intensity of exports is actually going up. And that means that earlier where we were relying on domestic material to export, and export was going up, and therefore the impact on the current account deficit was different. But given that the import intensity of exports is going up, that is also a challenge. But again, I think the single point that industry really wants is that we need to reduce the cost of doing business to enable us to become competitive and then compete with the rest in the world.
Oh yes, in fact, Dilip, you made a very important distinction between ease of doing business and cost of doing business, which perhaps only a practitioner like you would really know the difference. But now, Ashima, let me shift to the fourth parameter of basically assessing the health of the economy, and this is one on which we've done relatively well. In fact, inflation is the one parameter where we've had really unparalleled success. But have we had too much success? Have we paid a price for that success in terms of growth, Ashima?
Yes, I think so. There was a sort of single-minded focus on inflation targeting. It was interpreted strictly. But I believe there has been very substantial success in anchoring household expectations. And that means that going forward, you can be less worried about a little bit of a or rise in commodity prices. It will not necessarily pass through into inflation. The ultimate aim of an inflation targeting regime is really to anchor expectations so that you can focus on the real sector, on growth. And I think we should begin to do that now. Regard inflation targeting as done, now implement it more flexibly and focus on counter-cyclical policy. Because in the media and the discussion generally, when the RBI started cutting rates, there was a huge commotion that you're giving up inflation targeting, because it came with a change in regime. But that is what the data warranted, because inflation had fallen so much. And our real interest rates are some of the highest in the world. They have been that way for the last 4-5 years because inflation fell with the fall in commodity prices, but our nominal rates were not cut. So when Dilip says about industry and costs, I think high real interest rates are a major cost for industry and also made it difficult for them to get credit.
Is the real rate of interest, as Ashima said, much too high, and has that been a major factor as far as holding back private investment is concerned? What is the optimum level of, say, real interest rates that you think industry would be happy with, Dilip?
No, I think Ashima's point that we have the highest real interest rate anywhere is absolutely spot on. And if we're going to focus on targeting inflation and result in this high interest rate, I think nobody will want to go and access the domestic market for funds. But what is even challenging is given even the three rate cuts and possibly the lowest repo rate in a long time, the actual rate of interest to industry has not actually declined. Even if you take AAA plus rated companies, they're not getting money in single digit interest rates. So the availability of money is one thing and the interest rate is another. So Ashima earlier on the program made a point that nobody is actually coming for funds. They're not coming for funds because the cost of funds are too high and they will look at going elsewhere for money. So I think that is the key point here which needs to be done. And I think the point about inflation targeting, both the other panelists have really said what I wanted to say, so I won't repeat that.
Okay, so now that we've gone through the entire gamut of the four main parameters for measuring the health of the economy, the state of the economy, let me just quickly conclude by asking each of you in turn, given this kind of scenario that all of you have described, is there a case for a fiscal stimulus? Should we expect it, and can we look forward to it in the budget? What would you urge Nirmala Sitharaman to do? Let me start with you, Ashima, very quickly.
Yeah, as I said, I think they should keep the fiscal deficit target, but do some reallocation towards better quality expenditure, some tax cuts for stressed sectors, then something to reassure financial markets, this credit risk, some kind of fund that will restart, make finances available for housing, reduce the stock of housing that is unsold, start financial markets working smoothly so that funds come to industry. I think that is what the budget should focus on.
Okay. So Ashima's verdict is clearly stick to the deficit target but reallocate and use it better. Would you agree with that assessment, Anant?
I wouldn't mind even a small 0.2 to 0.3% slippage provided it is well directed, and the same criteria would apply to the government's demand for excess capital from RBI. As long as they are well directed and earmarked, I think one can accept a slight relaxation in quantity terms as well.
Okay, Dilip, where would you be? Would you be on Ashima's side, stick to that 3.4% but reallocate? Or would you be like Anand, okay with a marginal slippage of 0.2% or 0.3%? Where would you be, Dilip? And where would industry be happy?
So I think, if you reallocate resources and can achieve the fiscal, then it makes, is the ideal kind of situation. But given that you're in the first year of a 5-year government, you need to actually make some long-term investments, because if you need to invest in the agricultural sector, in irrigation, micro-irrigation, which are going to give you long-term benefits. So perhaps if you were to be able to look at long-term investments, productive investments that lead to addressing agricultural distress, look at raising the investment rate by giving a stimulus for household consumption and savings at the same time, and therefore reducing income tax coming in and therefore exceeding the fisc, it may actually be very productive in the medium and short and medium term, and also leading to long-term kind of growth, which will help us then address the fisc going forward. So, I think there are steps that will need to be taken, which will involve expenditure, and maybe also give some, tax concessions. Individuals actually currently don't have a 10% slab because of the interim budget, and the exemption for the taxpayers. We have a straight 20% slab. So those things will be able to correct it, which actually may reduce tax income, right? And therefore might lead to a different fisc. But if it is done in this way, then it could actually transform the whole economy.
Okay, so there we have it, a 360-degree view from three experts on the state of the economy as we go into Nirmala Sitharaman's maiden budget. A number of suggestions coming. Ideally, stick to the fiscal deficit target. If you have to exceed it, do so very marginally and do it for the right causes. So thank you so much, all three of you, Dilip, Anant and Ashima, for joining me in the discussion. Thank you also for watching. Remember, we'll be back with many more such shows on budget-related issues. Thank you once again from all of us at ET Now.